Assalamualaikum and hi everyone. We are from Group 3 and today our presentation is about auditing current asset. In our presentation, we will be discussing four main parts. First, the nature of current asset. Second, the audit accession and accounting treatment. Third, the accounting system and control activity. And the last one is the audit procedure. Okay, let's start by introducing our group members. My name is Nurshada Atira. With me today are Nur Farisha Amira, Siti Nadia, Nur Ain Shaira, and Irashin. Each of us will present different parts of this topic. So, let's begin our presentation with the first parts. I will hand it over to Farisha to present the nature of current asset.
Thank you, Shohada. Hi and Assalamualaikum. My name is Nur Farisha Amira binti Muhammad Zamri. My matrix number is 06DAT23F1084. So now I will explain the nature of current asset. So we will go to the next slide. So what is current asset? As we can see on the slide, current assets are items listed on a company's balance sheet that showing the total value of assets owned by the company within a specific period, which is in the short term. Okay, and then this asset can be converted into cash within 1 year through liquidation, use, or sales. For examples like inventory, account receivable, and cash. Okay. Why the current asset is important? Because the key role of this current asset is to reflect the company's short-term liquidity, meaning how quickly asset can be turned into cash. In addition, current assets are used to assess the company's ability to pay short-term obligations such as supply payments, employee wages, and other liabilities that must be settled within the year. So we will go to the next slide. Besides that, there are various types or components of current asset. As we can see that I put on the slide, we have four, which is cash and cash equivalent, account receivable, inventory, and other short-term investment. So I will explain the detail of nature of each component. So, the first one is cash and cash equivalent. So, what is cash and cash equivalent? Cash and cash equivalent are considered the most liquid assets on a company's balance sheet. This means that they can be quickly and easily used for transactions or to settle any obligations. Okay, we go to cash. Okay, cash refers to physical currency, coins, and as well as the funds a company holds in its checking and savings account. Okay, for cash equivalent, on the other hand, it is short-term investments, and they are highly liquid and carry very low risk of value fluctuations, and this is making them almost as safe as cash. Okay, common examples of cash equivalent is like money market funds, treasury bills, and commercial paper, and all of which can be converted into cash very quickly when needed. The second one is account receivable. So, what is account receivable? Account receivable represents the amount of money that customers owe to the company for goods or service that have already been delivered but not yet paid for. This usually happens when sales are made on credit. Okay. It is classified under current assets in the balance sheet as long as the payment is expected to be received within 1 year. Okay, the account receivable balance therefore shows the total amount of money that customers still owe to the company, and it is an important measure of the company's short-term financial health. So that's all for cash and cash equivalent and account receivable. So we will go to the next slide. The third one is inventory. Okay, inventory refers to all the items a company holds for production and sales. This includes the raw materials used to create goods as well as the products that are already completed and available for sale. Well, on the balance sheet, inventory is recorded as a current asset. Why? Because it is expected to be sold or used within 1 year. And then generally, inventory can be divided into three main types, which is raw materials, work in progress, and finished good. Okay, raw materials. Raw materials are the basic inputs or materials that a company needs in order to produce its product, while work in progress is items that are still processed or still being manufactured. and not yet completed. Okay, and the last one is finished good. Finished good are product that are already fully completed and ready to be sold. So the last one is other short-term investment. As we know, many companies place their liquid investments under the marketable securities account, but in some case, this investment may also be recorded under other short-term investment on the balance sheet. Okay, when a company has excess funds, instead of letting the money sit idle, it can be invested in short-term securities. This way, the fund are still working to generate returns while remaining easily accessible if the company needs them. So, that's all for the nature of current asset of each components. So, we will go to the next slide. Okay, now we will look at the inventory cycles in general. Okay, the first one is review records. Auditor check the company's inventory records like stock cards, inventory ledger, or system reports. Okay, why? It is because to see if the numbers record match with the real record. Okay, and then the second one is print or upload report. Okay, reports are prepared from the system to show what inventory should exist. Okay, this is to provide auditor with a basis to compare against with physical stock. And the third one is count. Okay, physical counting of items in the warehouse. Okay, the purpose is to confirm the actual quantity on hand. And the fourth one, investigate and reconcile. Okay, if records and counts don't match, the difference must be explained. Okay, this is why it is because to find the reasons such as error or damage on the report. Then when the auditor find the mistake, and then the next step will be alter procedures. If problems are found, company change how inventory is handled. This is to prevent mistakes or fraud in the future. Okay, and then the sixth one is adjust record. Okay, correct the inventory records to match actual counts. Okay, this is to make sure that books are accurate. And then the last one is calculate inventory record accuracy and repeat. So calculate how accurate the records were compared to actual stock. Then do the cycle again. So this is to monitor efficiency of inventory of management. So that's all the inventory cycle, and we will go to the next one. So the last one is source document. So as we know, there are many types of source document, and I only just put 4 in the slide on the slide. So the first one is cash in hand or bank. So the source document is cash receipt. The second one is inventory, which is the source document is good receipt note, and the third one is account receivable, and the source document is sales invoice, and the last one is other receivable, and the source document is debit notes. So there are so many more source document, and we can just find it. And that's all from me. We will go to the next presenter, Siti Nadia. Thank you.
Thank you to my friend Farisha Amira. My name is Siti Nadia Betty Bakery. My matrix number 0CD23F10X7. Okay, now I'll present about 3.2 auditization and accounting treatment. Okay, let's move to the next slide. Okay, now I will talk about the accounting treatment for cash and cash equivalent. Okay, what is cash and cash equivalent? Okay, cash and cash equivalent are the most liquid asset on the balance sheets. Okay, they also include currency, bank deposit, and other short-term investment. They are easy to convert into cash. Okay, for example, a company with 500,000 and 200,000 in short-term treasury bill would report 700,000 as cash and cash equivalent on its balance sheet. So, the accounting treatment that involved is debit treasury bill and credit cash. Okay, next slide. Okay, now I'll present about equity treatment for account receivable. Okay, what is account receivable? Account receivable represent amount owed to the company by customer for goods or service delivered on credit. Okay, they are a critical component of working capital management and reflect the company ability to collect payment efficiently. Okay, for example, if a company has issued invoice totaling RM300,000 to customer who have not paid the amount, so the amount will be recorded as account receivable. So the accounting treatment that involved is debit account receivable and credit sales revenue. Okay, next slide. Okay, now I will go to the accounting treatment for inventory. Okay, what is inventory? Okay, inventory consists of goods available for sale and raw material that used in production. Okay, so it is a significant asset for manufacturing and retail company, and it's also categorized into raw material, work in progress, and finished goods. Okay, example, a retailer with 150,000 in asuk merchandise will report this amount as inventory. So the accounting treatment that involved is debit inventory and credit cash. Okay, next slide. Okay, next we go to the accounting treatment for prepaid expenses. Okay, prepaid expenses are payment made in advance for goods or services to be received in the future. So they are initially recorded as asset and expenses over time as the benefit are realized. Okay, so for example, a company paying 12,000 for a 1 year insurance policy would initially record this amount as a prepaid expenses. Okay, so the accounting treatment that involved is debit prepaid insurance and credit cash. Okay, now we'll go to the auditization. Okay, firstly, I will go to the auditization for inventory. Okay, first we have existence, which is we want to see if the inventory balance report on the financial statement really exists at the reporting date, and then we want to see the completeness, which is the inventory must report the balance sheet include all inventory transactions that have occurred during the accounting period, and we want to see right and obligation, which is we want to see all inventory report on the financial statement at the report at the reporting date really belongs to the company or not. Okay, and then we have valuation, which is we want to see the inventory balance truly reflect to the economic value or not. And then we have presentation and disclosure, which is we want to see the inventory is properly classified and sufficiently disclosed to the notes on the financial statement. Okay, next I will go to the auditization for cash. Okay, we want to see the existence, which is the cash balance at the balance sheet really exists at the reporting date. Completeness, which is the cash balance include all cash transactions that have occurred during the accounting period or not. And then right and obligation, which is the company has title to the cash account at the reporting date or not. Okay, and then valuation or allocation, which is we want to see. Okay, the recorded balance sheet reflect the true underlying economic value of the cash and cash equivalent, and then we want to see the presentation and disclosure, which is the cash is properly classified on the balance sheet and adequate the disclosure that has been made in the rules in the notes to the financial statement. And then we will go to the auditization for account receivable, which is we want to see the existence, which is the account receivable that are shown on the balance sheet at the reporting date really exists or not. We want to see the completeness, which is all account receivable transaction that should have been recorded have complete. And then we want to see the right and obligation, which is the client has the right to control on the account receivable include in the financial statement. And the valuation, which is the amount at receivable have been recorded correct in mathematics, balance reflect and the actual economic value. And then we want to see the presentation, which is we want to see the asset, liability, and the equity interest are appropriately applicable in the financial reporting framework. Next we will go to the last auditization, which is prepaid expenses. Okay, firstly existence. Okay, prepaid expenses recorded in financial statement must actually exist at the reporting date. Completeness, we want to see that all prepaid expenses that should be recorded have been included in the financial statement. And then right and obligation, which is we want to confirm policy beneficiary. And if some inquire with insurance broker for external confirmation. And then we will have classification, which is we want to ensure proper classification at prepaid expenses. Valuation, we want to see the assess the portion of the policy that has expired and remains prepaid, and then we want to verify the accuracy of the adjusted entry for expired portion. Okay, thank you. That's all for now. Okay, next I will pass it to my friend.
Thank you to Siti Nadia. So next, I will explain about the accounting system and control activities related to current asset, which include cash and cash equivalents, account receivable, inventory, and short-term investment. So first, in the accounting system, cash and cash equivalent must be recorded promptly in the cash book and reconciled with the bank statement. Cash equivalent normally include short-term and highly liquid investment. For example, placing extra cash into a 3 month deposit is considered as a cash equivalent. From an audit perspective, audit will verify the cash book against bank statements and confirm balance directly with the bank. Next, for receivables, sales transactions are recorded directly in the sales ledger and this automatically generates the receivable. Receivables are also monitored through aging reports to identify overdue accounts. For example, if a customer has not paid after 60 days, the aging report will show this as overdue and the company can follow up. In audit, the auditor will check the accuracy of sales entries, review aging reports, and confirm balance with customers to ensure receivables are real and collectible. Third is inventory. It is recorded at the lower of cost. The valuation is determined using methods such as FIFO and weighted average. For example, using FIFO means if the company sells goods, the older stock purchase will be the record as sold first. Auditor will test inventory valuation by checking cost records, comparing with market price, and attending stock counts to ensure inventory actually exists. Last but not least, short-term investments are classified as current assets if the company intends to hold them for less than 12 months. They are recorded initially at cost and subsequent measured at fair value. For example, a company may buy shares in another company but only plans to hold them for 6 months before selling. For audits, the auditor will inspect investment contracts, verify value and with the market price, and ensure investments are properly classified as current. So, for overall, the accounting system shows how current assets are recorded and valued. An auditor will test this record to ensure they are accurate and comply with accounting system. Next, I will explain about control activities. For cash, the company performs monthly bank reconciliation to detect error and fraud. Segregation of duty is also applied where cash handler is separate from recording and reconciliation functions. In addition, physical control is implemented by keeping cash in the locked safe. For example, the person who receive cash payments should not be the same person preparing the bank reconciliations. From audit view, the auditor will review bank reconciliations and check whether duties are properly segregated to reduce risk and fraud. In receivables, regular monitoring is carried out to follow up on the overdue accounts and the reconcile with subsidiary ledger. Segregation is also important. For example, credit approval, invoicing, and collection should be handled by different personnel. Finally, authorization is required for write-off and discount, which needs managed to approval. For example, if a customer cannot pay and the receivable needs to be written off, it must be approved by the finance manager, not just a sales staff. In audit, auditor will check whether write-off are properly authorized and whether control reduce the risk of overstating receivable. For inventory, purchase must be approved by management before they are ordered. Segregation of duty is also applied, meaning purchasing, receiving, and recording should be handled by different staff to prevent frauds. For physical safeguards, inventories are stored in the secure warehouse with restricted access. For example, one staff can place the order, another staff can receive the goods, and a different person can record in the systems. In audits, auditor will access this control to ensure no thief. and there may be observed physical safeguards during the stock count. Last but not least, for short-term investment, authorization is required and must be approved by the board or management. Segregation of duty is also applied where investment decisions, custody, and recording are separate. In addition, proper documentation is needed, such as contract notes, broker statements, and confirmations. For example, if the company buys government bonds, the approval is done by management. The custody is handled by the bank, and the accounting department records is separately with supporting broker statements. From an audit perspective, auditor will verify proper authorizations, inspect supporting document, and confirm investments balance with brokers. In conclusion, the accounting system ensures correct recording and valuation of current assets, while control activities strengthen protections against frauds and errors. For auditor, both parts are important. The accounting system provides evidence, and the control activities show how reliable the evidence is. That's all from me. I will pass this presentation to Erosions.
Thank you to my friend Shuhada. My name is Hiroshin Tamilarasu. My matrix number is 06DAT23F1102. Now I'm going to present about audit procedures by evaluating the evidence provided or recommend to support the assertion and accounting treatment. There are two types of audit procedures, which is test of control and substantive test. Many of you don't know what is test of control. Test of control is an audit procedure performed to obtain evidence. The purpose of test of control is to assess the control system's consistency, to ascertain whether it is possible to reduce fundamental testing, to guarantee the existence, accuracy, completeness, and authorization of transaction. There are four types of method for test of control. The first one is inquiry. Inquiry is asking employee or supervisor how control are implemented. The second one is observation. Observation is observing how to cashier counts and deposit daily cash. The third method is inspection of documents, checking document for evidence of control. The last one is reperformance, reperforming the control activity to obtain to confirm accuracy. There are three types of inventories, which is the first one is authorization controls. Authorization controls verify the purchase requisition and purchase orders are properly approved before inventory is bought. The second inventory is recording and documentation control. Review whether all good received notes and good issues notes are matched with purchase order and invoice. The third inventory is periodic stock counts, which is observe the client's inventory and procedures. Uh, there are five assertions for cash and cash equivalent for test of control. The first assertion is existent. The cash balance recorded actually exists. Inspect monthly bank reconciliation signed by management. The second assertion is completeness. All cash transactions are recorded. Reperform matching of daily cash received with bank deposit. Accuracy. Cash balance are recorded at correct amount. Inquire procedures to record exchange gain or loss for foreign currency cash. Rights and obligations. Cash belongs to the entity. Review loan agreement to restriction on cash usage. The last assertion is disclosure. Cash is properly classified as bank, petty cash, and disclosure in financial statement. Inspect financial statement draft for classification of cash equivalent. The last one is trade receivable. The assertion of trade receivable is existent. Inspect sale invoice match with delivery orders. Observe procedures for verifying customer orders. The second assertion is completeness. inspect pre-number invoice, and check sequence for gaps. Reperform posting from sales invoice to ledger. The third one is accuracy. Inspect aged receivables, report for review and approval. Inquire about procedures for calculating doubtful debt provision. The fourth assertion is rights and obligation. Inquire whether receivables are pledged as collateral. Observe management review of receivable before year end. The last assertion is disclosure. Inquire about related party transaction. Review management review notes for disclosure approval. And I pass the slide to Ain Shahira.
Okay, Assalamualaikum. My name is Nur Ain Shahira. Nombor matric 06 di 82 KL 1075. Today I want to talk about substantive test for audit procedure for current asset. A substantive test is an audit procedure performed by the auditor to obtain evidence about the completeness, accuracy, and value on financial statement, balance, and transaction. It is used to detect material statement in the financial statement. First, current asset for cash. For existence, to ensure that the cash is actually in existence and belong to the company at a given date. Audit procedure perform a physical cash count and the company premise. Obtain bank confirmation letter directly from the bank to verify balance. Compare the bank statement balance with the cash book and bank reconciliation prepared by the client. Second is completeness, exertion to ensure that all cash transaction and balance have been recorded in the financial statement. For audit procedure, trace a sample of payment voucher to entries in the cash book. Review bank reconciliation for any outstanding deposit or unrecorded transaction. Check bank card or statement to identify receipt or payment recorded in the wrong period. Third, accuracy. Exertion to ensure that cash balance are correctly stated and agree with supporting documentation. Audit procedure recalculate the bank reconciliation prepared by the client. Compare the cash at bank per reconciliation to the audit bank confirmation. Verify any foreign currency bank account are translated at the correct exchange rate. Fourth is cut-off exertion to ensure that cash transactions are recorded in the correct accounting period. For audit procedure, review cash receipt and payment around the year and date to ensure they are posted in the right period. Inspect supporting documents such as invoice, bank deposit, slip, check, and other else. Trace bank transaction from the cut-off bank statement into the cash book. 5. Classification exertion to ensure that cash transactions are properly classified in the financial statement. For audit procedure, examine a sample of cash receipt and payment to confirm they are recorded under the correct account heading. Ensure cash equivalent such as short-term deposit are classified separate from operating cash. Second, substantive test for inventory. First, existence. To ensure that the inventory recorded in the book actually exists in the reporting dates. For audit procedure, first, perform observation at the physical inventory each at the end. Second, select sample from the inventory listing and physically inspect item the company. Second, completeness exertion to ensure that all inventory transaction and balance are completely recorded and properly disclosed in the financial statement. For audit procedure, first, trace sample from the warehouse flow to the inventory listing to confirm no item are omitted. Second, review the inventory reconciliation to identify any different or unrecorded item. Third, check that all relevant disclosed about inventory, such as valuation method, split inventory. Third is right and obligation exertion to confirm that the entity has legal ownership and right to the inventory recorded and that inventory does not belong to third party. For audit procedure, first, inspect purchase invoice, contract, and shipping document to confirm ownership. Second, inquire whether any inventory is held on consignment or pledged as collateral. Fourth is cut-off exertion to ensure that inventory movement, purchase, and sale are recorded in the correct accounting period. For audit procedure, first, inspect receipt report and shipping document around year end to verify proper timing. Second, match invoice and good receipt notes near year end with inventory in the purchase and sale journals. 5 is classification exertion to ensure that inventory is properly classified in the financial statement. For audit procedure, first, review whether inventory is correctly classified into raw material, work in progress, and finished good. Second, check the obsolete, damaged, or slow-moving inventory is separately identified or valued appropriately. Third is ensure that inventory balance are present currently under current asset in the statement of financial position. Substantive test for trade receivable. First, occurrence. Adjustment to ensure that all revenue transaction recorded as trade receivable actually occur and related to the entity. For audit procedure, first, select a sample of said invoice and trace them to supporting documents such as sales order and delivery notes. Second, confirm that said transactions are supported by dispatch documents showing delivery of goods. Second, incompleteness. Adjustment to ensure that all trade receivable that occurs during the period are recorded in the financial statement. For audit procedure, reconcile the age receivable listing with the general ledger control account. Second, trace shipping document or say invoice near year-end into the receivable ledger to check if all items are recorded. Third is accuracy. Assertion to ensure that trade receivable are recorded at the correct amounts and fairly presented. For the procedure, first, recalculate the age receivable listing to check mathematical accuracy. Second, verify the allowance for doubtful debt are appropriately estimated. Third, compare balance in the receivable ledger with supporting documents such as invoice. Fourth, cut-off. Assertion to ensure that receivables are recorded in the correct accounting period. For the procedure, first, check sale transaction year-end by compare invoice that with dispatch and delivery notes. Second, verify that goods dispatched before year-end are recorded as sold in the current year. Fifth, right and obligation. Assertion to ensure that the receivable included in the financial statement at the reporting dates belongs to the entity. For audit procedure, first, send debtors confirmation letter for positive or negative confirmation. Second, review sales contract and agreements to ensure receivables are not assigned factor on pledge. Third, inquire about any receivables sold or transferred to third parties. That's all from me. Okay, this is our reference. That's all from us by Group 3 from Current Assets. Thank you.